The relentless rise in inflation over the past few years has had a profound impact on American households, pushing many to the brink of financial strain. Yet, amidst this economic turbulence, a quiet revolution has taken place: the collective refusal of consumers to accept continually rising prices. From giant corporations like Amazon and Disney to everyday businesses, the message is clear: Americans are seeking value over excess, bargain over luxury. This consumer-driven resistance is not just shaping market trends, but may very well be the force that finally brings the inflation spike to its knees. As we witness this shift, we are left pondering: can the power of the consumer truly dictate the course of a nation's economic future? For nearly 3 years, Americans have endured a relentless surge in inflation, feeling the pinch in every corner of their lives from grocery aisles to gas pumps. Yet, as the dust begins to settle, it appears that the tide may be turning. And who deserves the credit? The everyday consumer who has decided that enough is enough. A growing number of America's leading companies, including industry giants like Amazon, Disney, and Yum Brands, are noticing a shift in consumer behavior. The average American, who once might have absorbed price hikes without much fuss, is now hunting for deals, opting for more affordable alternatives, or bypassing purchases altogether if prices seem too steep. This shift isn't drastic enough to cause a downturn in the economy, but it signals a return to pre-pandemic spending patterns when businesses couldn't easily raise prices without risking a loss in customer loyalty. Tom Barkin, president of the Federal Reserve Bank of Richmond, recently captured this sentiment at a conference, stating, "While inflation is down, prices are still high, and I think consumers have gotten to the point where they're just not accepting it." He emphasized that the natural remedy to high prices is, ironically, the persistence of high prices themselves. Essentially, when prices become too high, people simply stop buying. This emerging price sensitivity among consumers is a significant factor in the steady decline of inflation, which seems to be inching closer to the Federal Reserve's target of 2%. This shift not only relieves the burden on consumers, but also deflates a key issue in the presidential election, where inflation had become a major point of contention, particularly against the Biden-Harris administration. The ripple effect of consumer restraint is visible in the actions of companies, which are slowing down their price increases or even reversing them in some cases. As companies face the reality of a more frugal consumer base, the pressures driving inflation seem to be easing. The Federal Reserve Bank of New York's recent report underscores this trend. According to a survey, Americans now expect their spending to grow by just 4.9% over the next year, a figure that represents the lowest growth expectation since April 2021. This period marked the onset of the inflation surge. Additionally, expectations for inflation over the next 3 years have dropped to just 2.3%, the lowest since the survey's inception in 2013. Consumer expectations play a crucial role in the economy. When people believe that prices will remain stable or even decrease, they are more likely to delay purchases, further cooling inflationary pressures. But consumer behavior isn't the only factor taming inflation. Improvements in supply chains have led to increased availability of goods, from automobiles to household items. Moreover, the Federal Reserve's high interest rates have curtailed big-ticket purchases like homes and cars, further slowing the inflationary tide. However, there's a delicate balance to maintain. Consumer spending accounts for more than 2/3 of economic activity in the United States. If shoppers pull back too much, it could threaten the stability of the broader economy. This concern recently sparked a drop in stock prices, though markets have since rebounded. The upcoming government reports on inflation and consumer health will be closely watched. Economists expect that the Consumer Price Index for July will show a modest increase of 3.2% year-over-year, slightly down from June's 3.3%. If this holds true, it would be the lowest annual inflation figure since April 2021. Additionally, retail sales are anticipated to show a 0.3% increase from June, indicating that while consumers are cautious, they are not completely shutting their wallets. This cautious spending is being observed across industries. For instance, Amazon CEO Andrew Jassy noted that consumers are increasingly opting for lower-priced items. Similarly, David Gibbs, CEO of Yum Brands, which owns Taco Bell, KFC, and Pizza Hut, reported a slowdown in sales due to cost-conscious consumers. Ensuring we provide consumers affordable options, Gibbs said, has been an area of greater focus for us since last year. Some businesses are even slashing prices to entice customers. Dormify, an online retailer specializing in dorm supplies, has reduced the price of comforters from $99 to $69. The Federal Reserve's Beige Book, a collection of anecdotal reports from businesses nationwide, highlights that companies in nearly every Fed district have observed similar trends. Consumers are becoming more selective, purchasing only essentials, opting for lower-quality alternatives, or shopping around for the best deals. Despite this tightening of the purse strings, most economists believe that consumer spending remains robust enough to keep the economy afloat. Tom Barkin noted that in his district covering Virginia, West Virginia, Maryland, and the Carolinas, businesses report steady demand, but only at the right price. Consumers are still spending, he said. The Biden administration's economic advisors have also weighed in. Jared Bernstein, head of the Council of Economic Advisors, attributed the nearing end of the inflation spike to more discerning consumer habits. He pointed out that post-pandemic, consumers were flush with cash, which gave companies the leeway to increase prices without much pushback. However, this has changed as consumers have become more resistant to price hikes, bringing the economy back in line with pre-pandemic norms. Before the pandemic, inflation was kept in check by a combination of factors, including the rise of online shopping, which made price comparisons easier, and cost-cutting by major retailers. Additionally, increased oil production helped keep gas prices low. Back then, price increases were so rare that any significant hike would have been met with disbelief. The pandemic, however, upended this equilibrium. Labor shortages, supply chain disruptions, and price hikes became the norm. Consumers had little choice but to accept these increases as they struggled to meet their basic needs. Isabella Weber, an economist at the University of Massachusetts, Amherst, coined the term seller's inflation to describe this phenomenon. In her research, she argued that supply chain bottlenecks and other disruptions allowed companies to justify price hikes, which consumers grudgingly accepted. Now, however, consumers are no longer as willing to pay inflated prices. Barkin captured this shift when he remarked, "People have a little bit more time to stop and say, how do I feel about paying $9.89 for a 12-pack of Diet Coke when I used to pay $5.99. They don't like it that much, and so people are making choices." This new consumer mindset is expected to continue slowing price increases and cooling inflation. Barkin expressed optimism that inflation readings in the coming months would reflect this trend, with all signs pointing toward a stabilization of the economic environment. As we observe this unfolding dynamic, we are left with a question that challenges our understanding of economic power. Can the collective will of consumers, armed with nothing more than the resolve to spend wisely, truly reshape the economic landscape? And if so, what does this mean for the future of consumer-driven economies? Share your thoughts and experiences as we navigate this crucial moment in economic history.